Welcome to our High Rock monthly video for December. We are, January. And I hope that everybody had a great holiday season. With me on the call today is Paul Tepsich, the managing partner and founder of High Rock. And Paul, we're going to jump right into talking about what transpired in financial markets in December. Preferred shares continued to perform well in December relative to everything else, which basically everything else was slightly to somewhat negative.
Yeah, they continue to do well, Scott, and we'll maybe talk just briefly now and again later when we talk about our preferred share mandate. But a lot of the supply in the Canadian preferred share market has been taken out, roughly 7.5 billion or so over the past year, just in bank preferreds. So that market is shrinking for sure. So that's part of the reason why they've done so well. If you look at the other end, REITs have not done well, certainly in the back part of 2024. Interest rates went up, i.e. government bond yields, and that certainly doesn't reflect well in the REIT market.
Right. And interestingly, over the course of the year, Canadian preferreds kept pace with U.S. equities. And I know that you've got a lot to say, but Canadian equities fared reasonably well. And all told, most balanced portfolios fared well over the course of the year as well. And we'll get to that in a little bit. One thing that didn't fare well was the Canadian dollar, Paul.
Yeah, no kidding. And everybody probably knows the story now, but as you point out here, Scott, over the course of the year, it was down almost 8%. So I'm going to just make a couple comments on that. I think we were just in the month of December alone, we were down about 2.3%. And you can see we've moved marginally stronger just when Trudeau said he was resigning, or pseudo resignation, I suppose. But one thing to keep in mind is most of our portfolios have about 20% in US dollars. So on that type of move, with the currency coming off roughly 8%, that gave roughly a 1.6% positive performance to our overall portfolios being priced in US dollars. Across the month of December, it added maybe 0.5% alone. So that is part of our passive and natural portfolio hedge by owning US dollars. It obviously doesn't always work in our favor, but in my personal view is I think the currency dollar Canada is trading around 143 right now. It got up north of 144. I think it's going to test 150 personally. You can look at what's going on in the UK as well. We can talk a bit more about that perhaps as it relates to our fixed income model.
All right. And just in terms of this slide, 150 takes us closer to that 65-cent range, right?
That's nasty. It's everything we buy as Canadians is priced in US dollars. Clothing, food, infrastructure, everything is priced in US dollars.
And if you spend your winters in Florida or in warmer climates, you'll feel the pinch.
Yeah, and it is cold out today.
So one of the themes of the last few monthly videos has been to look at the perspective over the last 3 years, because 2022 was a very difficult year. And while these are just prices, so these are not total returns, you get a sense of how things have gone over the course of that 3-year period. Certainly 2022 was very difficult. And while markets have bounced back, on average over those 3 years, 2022 has dragged the average portfolio performance lower over the 3 and even the 5-year period of time. And so when we look at how that 3-year total return has evolved over 3 years, we look at global equity markets that are basically annualized returns of 5.5%. The Morningstar average of balanced funds uh, at about 3.6. So on average annual yield, that's not really very strong. And of course, Canadian bonds have on a total return basis been negative over 3 years, and certainly that's because interest rates moved higher and inflation moved higher and bonds were sold off. Paul, any comments on this at all?
Yeah, and it's kind of the same thing going on. And again, we can talk a bit more about what's happening in the bond market in the fixed income section, maybe.
Yeah.
But
Well, and one of the things for our clients is, when you look at your portfolio returns over 3 years, you want to compare it to what's happened on average in the Morningstar. And Paul, I would say that uh, almost all of our clients have performed better than that for a number of reasons, and that's because we manage risk, and we'll get into the management of risk in more detail in just a second. But
yeah,
let's
that's
look
great.
at what happened over the course of um, last year in balanced portfolios. The Morningstar average was uh, up about 13 and a quarter on over 1 year in 2024, which was better than 2023, which was significantly better than 2022. Again, that 3 year average and even the 5 year average at 5.25. Um, Again, what we put these up here for is for clients to make comparisons to the performance of their portfolio. And when they do, if they have any questions regarding their portfolio, that's the time to come to us, and we'll certainly have a conversation. I've had some conversations already this year, which has been great. But I think the real key to focus on down here is what we call the risk. We look at the standard deviation from the mean. What's one standard deviation move in a balanced portfolio in the Morningstar averages is about 9.35%. So if you're getting a 5.25 return and you get a 9.35 move in your portfolio up or down, um, that's something that is built into the risk. And I'll just get into that in a little bit more detail in a second. But what we want to look at is what return you're getting relative to the risk you're taking. Now, we will tell our clients that over this 5 year period, their standard deviation is somewhat less than the 9.35 average, closer to a 7 or a 7.5, which makes your 5 year annual or your 5 year return relative to risk significantly better. So that's something to keep in mind. And I'll talk a little bit more about this standard deviation thing here. Paul, feel free to chime in. But what we're looking for, and this is just an example. So if you had all your money in the S&P 500 index ETF, which is SPY, the 5 year standard deviation for that. So the movement up or down, one standard deviation move up or down is just a little over 18%. Now, go down to this big circle here, 2022, which we often refer back to. We saw a negative return in 9 months from January 2022 to September, the end of September 2022, of almost 24%. So if you think about $1 million investment in this ETF, it dropped by almost 25%. So you saw your $1 million investment go to 750,000. So that's $250,000 lower. We ask ourselves, is that something we can sleep with or be happy with or get good sleep if that's
Sleep
happening to us?
soundly.
Sleep soundly. And for me, the answer would be no. Again, that's a question that clients need to ask themselves, but that's why we look at these things. Now let's look at a balanced situation. balance is supposed to help mitigate the downside, and it does. You can look and see the standard deviation on a balanced portfolio. We're using the Maurer balance because that's the data we have from, and it's a well-known balanced fund. Um, but again, that 9.3 standard deviation means that your portfolio could swing up or down 9% or thereabouts. In one standard deviation move. Now you look at the drawdown in 2022, it was considerably more than a one standard deviation move. It was down almost 17%. And that's $1 million investment, again, down 170,000. Is that something you can be comfortable with? And again, I say no. And that's why what we do in our portfolios, if we and most clients in 2022 can look and see that their portfolios were maybe down 7, maybe down 8%. So you're talking on $1 million portfolio, 70 or 80,000 during this drawdown period. Maybe you can live with that. Not happy with it, but you can live with that, and it doesn't trigger any panic. And really, that's what we talk about when we're talking about risk adjusted returns. We want to make sure that we're taking as little risk as possible, so we mitigate that downside. And by doing so, when we come back to growth, we're able to get growth more quickly. And that's what's happened in 2023 and 2024 for our client portfolios, is they're getting back to growth more quickly and outperforming the average balance fund.
Scott, those are two really good slides. I just have two comments. Going back to the SPY slide, I want to make sure, number one, that people do understand that if you're looking at your own performance, this is the time of year, December, January, everybody talks about performance. Oh, how was your portfolio? What'd you make? You have to make sure you're looking and comparing apples to apples. So most of our clients, we have some special mandates, but our other clients in our balanced portfolios are in a balanced portfolio. It's got some stocks, it's got some bonds, it's got some preferred shares, etc. It's balanced by design, as you can see by the standard deviation, to limit some of that. Now, for that, we miss some of the upside, of course. So when you can't just look at your portfolio and say, well, the SPY was up 25% or whatever it was. You have to understand we are in a balanced portfolio by design for the long haul. So that's number one. Number two, I would also say, if somebody said, well, yeah, the SPY in 2022, 9 months, it was down 25% roughly, but then it was up 25% in 2023 and up 25% in 2024. But timing is everything. So I would caution people thinking that way, that, oh, I'll just ride it out. People that said that in 1999 and 2000 into the dot-com bubble in triple Qs or the NASDAQ, it took the NASDAQ 16 years to get back to its high water mark. So think about that. You can look at a chart, but if you bought at the peak in 1999 or early 2000, at the peak in triple Qs or the NASDAQ in general, it took you 16 years to get back to where you bought. That, for most people, is completely, it's called dead money. You put $1 million into the NASDAQ, and you would have seen your $1 million on a mark-to-market basis get back there in 2016. That is crazy. So those are two things I would caution on.
Yeah, and that's great. And again, we have compare ourselves to other balanced mandates, and one thing that stands out, if most clients look at their portfolio performance, you'll see that your standard deviation number is closer to 7.5, which means that we are taking significantly less risk, which actually, again, as I said, does mitigate the downside. And by virtue of mitigating the downside, you get back to growth more quickly. So that's why you want to take volatility out of your portfolio if you can, and you'll sleep better at night. Again, this is all to be taken into the context of everybody's personal situation. So we're wide open to have these conversations. Paul? Do you want to talk about the special mandates?
Yeah. Preferred shares first. I mentioned briefly, as we saw in one of the earlier charts, Scott, that they had a great year. We had great timing. We literally an extra 2 weeks earlier, and we would have been up another 2 or 3%. But that's nitpicking when we were up. I can't. We don't divulge performance, but it was a substantial year for those that took part in our preferred share mandate last October, November, and into some people even into December. It was a spectacular opportunity for us. So they've done well. And again, part of that is because the banks, and we were able to, it was a two-part thing. The banks really started redeeming their rate reset preferred shares as they came up for redemption or extension. So they're pulling them out and they're issuing other alternative tier one capital securities for the regulatory purposes and buying these out or redeeming them. So they, over the past year have taken out roughly 7.7 billion out of a, 45 billion pie. So the market has shrunk. So going forward, well, I should back up a little bit. We did own quite a few big weights in bank preferreds. That certainly helped our performance, but some of the other corporates are starting to redeem as well. So the size of the market is shrinking. And there are still some big ETFs out there that need to redeploy the capital when these bank preferreds get called. So that's one thing, one dynamic. And the second dynamic is there are other corporates, non-banks, that are starting to redeem as well. Fairfax, Synovus, just to name a couple. So even these corporates are starting to do the same. I think the next wave will be the insurance companies starting to redeem. At some point, the preferred share market is going to end up being so bloody small, it won't really be all that tradable. But I think for the next couple of years, we're going to have a pretty decent technical tailwind between supply and demand. So that's the preferred share mandate. The high yield mandate, steady Eddie, as we described to those that are invested in that mandate. It was a good coupon year. The energy space, we are still quite overweight at around 30 odd percent. We will stay that way. They're not terribly sexy bonds right now to own, but they are steady Eddie. They have very, very good credit metrics, i.e. good balance sheets. They're running very little, if any, leverage or debt versus their cash flow. And we're just clipping out that coupon every day we own the bond. Most of our clients own that in their registered type accounts or tax advantage type accounts. And I think that's the place to own it. That's it for those two special mandates, Scott.
Yeah, and again with the high yield mandate, over the last 5 years, the average annual return, by virtue of how well it has done, has significantly outperformed any of the balanced mandate as well. So it's been an interesting period of time.
That's a good point. And again, not to dwell down too far on performance, but and this might be complicated without a chart, but when you're investing in high yield, it sounds scary. The other term is junk bonds, but they are senior bonds. They're pretty far up what's called the capital structure of a company. They're typically one level below the secured bank debt, and some of the bonds we own are secured. But you get down lower to preferred shares and then common equity. Common equity is at the bottom of the capital structure. It has the least, if there is a problem, it has the least amount of recovery in it. So this is senior debt, and it has, so far it's had, and typically does over 5, 10, 20-year periods, very low volatility. So that's why we love that asset class. So we will continue moving forward with that.
Thank you. Excellent work. Let's quickly talk about the global equity strategy and a little bit of what happened over the course of the year in the global equity model. U.S. large cap stocks were really driving the global equity model. Although Canadian equity did well, emerging equity also did well, and even the U.S. mid and the small companies did quite well. To add to how well our global equity model did. The one drag really on the global equity model, well, the two drags really were Europe, Australia, Far East. So the international flavor in U.S. dollars, not so much uh, in the Canadian dollar terms because of the weakness of the Canadian dollar. So we benefited for that. And then in the international small equity space, which we own very small, I think it's basically 1% of the total portfolio. So very minimal there. But it did, in general, the U.S. large cap equity, Canadian equity all helped the global equity model over the course of the year. Tactical update, Paul? Paul, did I lose you? I think you might be on mute.
I am sorry. Tactically, we didn't do any trades or changes in positions really. Just across the month of December, we did see a bit of a drop in our Baytex stock by about roughly 20%. That has bounced back over the past week or so with the price of oil moving back up. And of course, you know, it's an oil stock, so it's going to move with the price of oil, and it has it actually has a little bit more leverage on it. Our biggest position, Source Energy, that actually came off about 6% across the month. I think there's on that position, it's trading at the lowest valuation I think I've seen in a long time of any company. I've seen one cheaper in my career, but this one is probably the second cheapest I've seen. But there is some, I think, some technical selling from some bondholders that own stock. They were given stock as part of a restructuring a number of years ago. So I think there's been some selling pressure on this thing. The company did just announce a refinance of their bond. So they're a bond our high yield investors still own, and we used to own in the balance mandates up until I think it was May. That was a phenomenal investment for us over a 2.5-year period. So the stock itself is still up. We're up about 50% on it. I think it's trading around $15. I think the stock is going to be taken out well north at 25 at some point in the near to midterm future. So I love that position, but that's about it for a tactical. Fixed income. This is kind of interesting. I'll just highlight a couple things across the month of December. So interest rates, i.e. government bond yields, went up substantially in the US. They were up about 40 basis points in the 10-year sector, whereas Canadian government bonds were only up about 15 basis points, 1.5. When bond yields go up, prices go down. So on the whole, our government bonds detracted from performance, and because investment grade trade quite closely correlated to government bonds, they detracted a little bit too. High yield were off a little bit, and preferred shares, as we talked before, were actually up. And our last bank preferred share that we own, both in the preferred share mandate and the balance mandate we're looking at now, will be redeemed. CIBC pref will be redeemed on January 31st. So we'll go up more cash. I think what's really interesting to think about, Scott, is government bond yields are skyrocketing, and this is in the face of central banks cutting rates. So now the bond market, I think 6 months ago, was telling central banks they were behind the curve, they needed to cut rates. So the central bank started cutting rates. Now bond yields are going up, which sounds counterintuitive. But in some parts of the world, inflation has ticked up. And I mean, just ticked up. It's not like it's skyrocketed. And the bond market is getting nervous. Inflation is the number one enemy of bonds. It destroys your purchasing power. So, for instance, if we look at 10-year government bond yields in the US since like a 3-month span from September to December, the last quarter of the year, they were up 100 basis points, like 1 full percent. Same in the UK. And the UK right now looks like it's got a real problem. 10-year yields in the UK bond market are, darn near multi-decade highs at around 480. So there's a problem going on. I think part of what we're seeing is the bond, so-called quote unquote bond vigilantes that are saying, you know what, your fiscal situations, and I'm not just saying the UK, but I think all over the world, here in Western world, Canada, we'll talk about that in a second. The US, if the US dollar wasn't the reserve currency of the world, it would be in the same boat. But you can see what is happening. The US yields, they've skyrocketed, and they've gone up about 100 basis points over the last 3 or 4 months as well. So bond investors are, I think, very concerned about these massive fiscal deficits that these G7, or well, let's just say these Western democracies through Europe, including the UK, the US, Canada, are running. These are problematic. So for Canada specifically, we can go back and look at the Canadian dollar chart, but my one concern would be that we go off the reservation with regards to our deficit financing. I mean, we were expecting a $40 billion deficit and we came out with 60. If we have a run on the currency, that's going to be a really, really bad thing. So the currency has improved like marginally, very marginally, just with Trudeau's announcement the other day. But if we have a run on the currency, i.e., all these macro hedge funds around the world start shorting the Canadian dollar and pushing it weaker and weaker and weaker, the Bank of Canada may have to come in, or it will have to come in if that happens. If that happens, they will have to come in and actually raise short-term rates. They've been cutting short-term rates for a while, and we as consumers have enjoyed it. If they have to defend what's called defend the currency, because that's how currencies move. Right now, the spread between a Government of Canada bond and a US bond is very, very wide, i.e. the US bond is much higher yield than the Canadian bond. If they have to defend the currency, it's going to be ugly in Canada. And that's something that, Scott, you and I have to keep an eye on for sure.
Yeah, and it's definitely not good for the Canadian economy. And it certainly isn't good for the Canadian housing market, which has been suffering for at least the last year and a half. So there's a lot of things that will come from any significant depreciation of the Canadian dollar. And you're right, we do have to be monitoring that closely.
Yeah.
All right, let's go through some admin stuff. If you do use the client login to Raymond James to check your accounts from time to time, Raymond James is now requiring, or will be as of February the 3rd, requiring a 2-factor authentication. When you go into log into your account, you'll see that this has to be set up. If you run into any situations where you need assistance, please don't hesitate to get in touch with us. We're happy to make sure that you have access to your Raymond James accounts at all times. So please let us know if we can assist. And finally, one more admin thing. This year's TFSA limit is $7,000. If you have maxed out previously, you're allowed to put in another 7,000. If you haven't maxed out in the past, then it's time to find out if you how much you can put in. It's always good to maximize your TFSA, because money going into the TFSA as it grows is not taxed, and there is no tax consequences when you go to withdraw it at the other end. So it is an incredibly good account to utilize for all investors. And I'm always happy to have conversations around that and what you should prioritize with regards to TFSAs, RSPs, and other tax deferred accounts. So just let me know. And we have kept you very, very long today, and our apologies for all the information, but it's a brand new year, and we want to make sure that we're communicating all of our thoughts. So we want to thank you for taking time time out of your busy schedule to tune in. I will address the picture. The young gentleman that we sponsor in the AAA Ontario Hockey League is being scouted by the London Knights of the Ontario Major Junior Hockey League, which is excellent. And we're excited for him, and we hope and wish him all the best in the rest of his season in 2025. On that note, this is Scott Tomlinson, and on behalf of my colleagues Paul and Diane, we wish you all the best for 2025, and we look forward to presenting again on our video at the beginning of February. Until then, all the best.